He was a successful restaurant owner, a pillar of his community. But for 3 years, he skimmed a little bit from the cash register each night. He told himself it was just to make ends meet, a harmless off-the-books bonus. But the IRS, they called it a crime. That little bit ended with him losing his business and serving 24 months in federal prison. What he did wasn't a simple mistake, it was a willful crime. So what's the line that separates a scary letter from the IRS and a prison sentence? You might think it was just a small error on your tax return, but the IRS could see it as a deliberate choice to break the law. In this video, we are pulling back the curtain on the critical difference between a tax mistake, tax fraud, and tax evasion, and what you absolutely have to know to stay on the right side of the law. Section 1. The problem and the promise. Let's be real. Few things kick up more anxiety than a letter from the IRS. Your mind immediately starts racing. Did I mess up? Am I going to get hit with a massive penalty? Could I actually go to jail? This fear of the unknown is a huge pain point for taxpayers. The most common questions are things like, will I go to jail for a tax mistake? Or what happens if I forgot to report some income? But here's what I can promise you. By the end of this video, that fear is going to be replaced with clarity. You will understand the bright, clear line the IRS and federal prosecutors draw between a simple, non-criminal mistake and a criminal act. You'll know the exact legal standard they use, and you'll have a practical framework to make sure you never, ever cross that line. Most tax problems are not criminal, but the ones that are can change your life forever. Knowing the difference is your best defense. Section 2. The simple tax mistake. First up, let's talk about the most common situation, the simple tax mistake. A tax mistake is an unintentional error. It's a slip-up. Maybe you transposed a couple of numbers, forgot to include a 1,099 from a small gig, or messed up a deduction because the rules were genuinely confusing. The key is you weren't trying to deceive anyone. Now, if you were careless in a way the IRS thinks you should have known better, that's technically called negligence. But even then, what happens when the IRS finds a mistake? They don't send agents knocking on your door. They send you a letter. Often, this is a CP 2000 notice, which says the income they have on file doesn't match what you reported. You'll be asked to pay the tax you owe, plus interest. You might also get hit with an accuracy-related penalty, which is typically 20% of the underpayment. It's a financial headache for sure, but let's be crystal clear. An honest mistake gets you a bill, not a jail cell. The main takeaway here is that the system is built to correct unintentional errors with civil penalties. Criminal prosecution is reserved for something much more serious. Section 3, tax fraud. Now we're crossing the line into much more dangerous territory with tax fraud. The single most important word that separates a mistake from fraud is intent. Tax fraud is the intentional or willful deception of the IRS to pay less tax than you legally owe. This isn't an oops, this is knowing the law and deliberately choosing to break it. Tax fraud is a big umbrella term for all the ways people cheat on their taxes. Examples include knowingly claiming deductions you're not entitled to, inventing dependents, or deliberately hiding income. So, if you write off your family vacation to Disney World as a business trip, you're driving straight from mistake into fraud territory. When the IRS suspects fraud, they have two ways to come after you, civilly and criminally. In a civil fraud case, the penalty is a whopping 75% of the underpayment due to fraud, on top of the back taxes and interest. While that's severe, it still doesn't involve prison. However, when the fraud is bad enough, it can become a criminal matter, which brings us to the most serious offense of all, tax evasion. Section 4, the crime of tax evasion. Tax evasion isn't just a catch-all phrase, it's a specific felony under U.S. law, 26 U.S. Code 7201. All tax evasion is a form of tax fraud, but for the government to get a criminal conviction, they have to prove three specific things beyond a reasonable doubt. 1. There was an additional tax due and owing. 2. You acted willfully to get out of paying it. 3. You took an affirmative act to mislead the government or conceal the tax. That affirmative act is critical. Just failing to file a tax return by itself is usually a misdemeanor, not a felony. But if you don't file and you do something else to hide or deceive, like creating fake invoices, hiding money in offshore accounts, or lying to investigators, that's when it escalates to felony evasion. The penalties for criminal tax evasion are harsh. Fines up to $100,000 for an individual, or $500,000 for a corporation, and up to 5 years in federal prison for each offense. This is the charge that puts people behind bars. Section 5, the core lesson, how the IRS proves willful intent. So, how does the IRS prove what was going on in your head? They don't have mind-reading powers. Instead, they build a case by looking for specific patterns of behavior that they call the badges of fraud. These are red flags that, when you see enough of them together, paint a pretty clear picture of deliberate deception, not an honest mistake. An IRS agent is trained to spot these during an audit. Some of the biggest badges of fraud include consistently forgetting to report income, especially from side businesses or cash-heavy work, is a huge red flag. Keeping two sets of books. This is the classic sign of fraud. One set of real records for you and a fake set to show the tax man. Dealing in large amounts of cash. Destroying records. If you learn you're being audited and suddenly your records go up in smoke, that screams guilty. Making false statements. Lying to an IRS agent, creating fake invoices, or submitting forged documents are all considered affirmative acts of evasion. A consistent pattern of mistakes. Making the same error that just so happens to lower your tax bill year after year stops looking like a mistake and starts looking intentional. Concealing assets. Hiding money or property in offshore accounts under other people's names or in complex trusts is a massive badge of fraud. Remember our restaurant owner? He didn't just make one error. He engaged in a consistent pattern of skimming cash, understating income, kept inaccurate books, and deliberately hid his real earnings for years. Those are the badges of fraud that turned his tax problem into a prison sentence. Section 6. The stakes. What actually gets you jail? Let's make this dead simple with a couple of comparisons. What gets you a penalty? You're a graphic designer, and you forgot to include a $1,500 1099 from a small client. It was an honest oversight. A year later, the IRS sends you a CP 2000 notice. You respond, you say, "You're right, my mistake," and you pay the extra tax plus a 20% accuracy penalty and some interest. Your case is closed. You're not going to jail. What gets you investigated for a crime? You're a contractor who gets paid $60,000 in cash over the year. You deliberately don't deposit that cash into your business account and don't report a dime of it on your tax return. When the IRS audits you and asks about your income, you lie. This isn't a mistake. This involves hiding income, dealing in cash to conceal it, and making false statements, all powerful badges of fraud that can lead to a criminal referral. We see this in real court cases all the time. The owners of a nail salon chain were prosecuted for running a massive cash payroll to help employees evade taxes. A businessman admitted to tax evasion after paying his employees in cash for years and not reporting it. These weren't math errors. They were deliberate criminal schemes. Section 7, the solution. So, what should you do to make sure you stay on the right side of this line? If you find a mistake, fix it proactively. If you realize you made an error on a past return, don't just hope the IRS won't notice. Be proactive and file an amended return. Voluntarily correcting a mistake is powerful evidence that you never intended to commit fraud. If you get an IRS notice, respond honestly. Don't ignore it. Open the mail, read it, and respond. If the IRS is right, agree and pay what you owe. If they're wrong, explain why and provide your proof. If you are audited, do not lie or destroy records. This is the fastest way to turn a civil audit into a criminal investigation. Every lie is just another badge of fraud that they can use against you. And this brings me to the single most important piece of advice in this video. I'm tax attorney Chad Silver, founder of Silver Tax Group. If you are even slightly concerned that your actions might have crossed the line from a mistake into fraud, if you have unreported income or claim deductions you knew were bogus, do not talk to the IRS. Your very first call should be to a qualified tax attorney. While there's a limited privilege for non-criminal matters with CPAs and other tax preparers, that privilege does not apply in a criminal investigation. Communications with a tax attorney, on the other hand, are protected by attorney-client privilege, which is a much stronger shield. Call us at 855-900-1040 for a confidential criminal tax consultation. If this video brought you some much-needed clarity on this topic, do me a favor and hit that like button and subscribe for more straight-up, no-nonsense financial guidance. Thanks for watching.